Buffett is sitting on a mountain of money and he can do what he's never done before. Let's get straight to the point. Warren Buffett has more money sitting idle than he has ever had in history. We are talking about $347 billion in cash. This is not an exaggeration, it's a fact. Just so you know, this is more money than Microsoft, Google, Amazon and Meta have together. Now think with me. This is the same Buffett who always believed in buying good stocks and holding them for decades. The same guy who was never a fan of leaving money idle, much less pay dividends to shareholders, something Berkshire Hathaway did only once, in 1967, and never again. So why is he hoarding so much money now? Why is someone who has always reinvested profits saving everything? Simple. He believes that now is not the time to buy. It is the time to wait. And the buzz behind the scenes has already begun. If this money remains idle, Buffett may be forced to do what he has always avoided, pay dividends. That's right. The man who always said reinvest instead of distribute may end up distributing profits because he sees no value in almost anything in this overvalued market. Now stop and think. See, the greatest opportunity hunter of the world is choosing wait, accumulate, and perhaps even pay dividends for the first time in half a century, should you be chasing any trendy stocks. This move isn't caution, it's strategy. And in this game, whoever follows the smart money survives. Whoever ignores it loses. Now that you understand that Buffett is sitting on a giant safe, let me tell you the most intriguing thing. He didn't just stop buying, he started selling, and he sold a lot. And don't think he got rid of bad or bankrupt companies. Not at all. He sold shares in companies that are growing, profitable, and that everyone wants to have in their portfolio. Examples: new holdings, Snowflake, Floor & Decor, HP, and even giants like Chevron, Apple, and Bank of America. Look how crazy. New Holdings, the world's largest digital bank by number of customers, is growing like a rocket. And Buffett sold 100% of the shares. Yes, he made a profit. But if the future is so promising, why didn't he stay longer? Snowflake, a powerhouse in artificial intelligence and cloud data with exploding revenue, he also left. Apple, Bank of America, sold billions in shares of these giants. Do you know what that screams behind the scenes? The market is overpriced, prices are too high, and whoever keeps buying at the top will bleed. Now look at the irony. While many beginning investors are chasing promising stocks and thinking about quick profits, Buffett is selling what has already appreciated and accumulating cash. That's it, professional investors' mind. He sell when everyone is euphoric and buy when everyone is afraid. And here comes the twist. If he keeps selling at this rate and doesn't find good companies at a fair price, do you know what could happen? He can start paying dividends on all that cash for the first time in over 50 years. In other words, even Buffett is preparing for a new kind of game. And you're still playing the old one? Want to invest like Warren Buffett? Sign up now and start thinking like a true market master. Buffett is not a passive investor. He wants to control the game. Many people think Buffett just buys and forgets, like any other passive investor. But that's not how he plays. He's a hunter, an active strategist who knows exactly when to enter, exit, and how to protect his wealth. So when you see that he sold S&P 500 ETFs, which are precisely those funds that simply follow the market, it's clear that he didn't do it. Buffett is not a spectator. He is the captain of the ship. He doesn't like to go with the flow. What's more, he's passing the baton to a new CEO at Berkshire Hathaway, Greg Abel. This means decisions may become less conservative, perhaps more aggressive, perhaps even with dividends becoming part of the strategy. Why does this matter to you? Because the Buffett style may be changing, and that change could create unprecedented opportunities for those who know how to time it right. If the new boss is more hands-on and wants to pay dividends, this could be the signal traditional investors have been waiting for: cash in their pockets without having to sell shares. So stay tuned. The Buffett era you know is changing, and with it, the way you invest needs to change too. He profited and exited at the right time, the art of selling at the top. Here's a lesson few want to admit. Buffett isn't just a patient buyer. He knows how to sell at the right time. Look at what he did with Chevron, for example. He bought shares when they were low, paid a good price, and now that the price has risen significantly, he's selling them slowly, taking profits. This isn't amateur stuff, it's a master strategy. And don't think he's abandoning the oil sector. He's just reducing his position to not get stuck with a price that is already too high. Like what? You should do too to protect your earnings. This is the mentality that separates the investor who gets rich from the one who just hopes the market goes up. He doesn't hold on to the stock just because he likes the company. Buffett sells when the price is beyond the real value. This is selling with intelligence, not fear. Want to be that investor? Learn how to sell the top, not buying the top. Because everyone buys at the top, but few know that selling at the top is where the real profit is. Tired of losing money with bad decisions? Sign up and learn the strategies top investors use to consistently win. Buffett breaks sales into pieces. The cautious hunter's tactic. Don't expect Buffett to play all his cards at once. He sells in increments, calculatedly, like a seasoned hunter who never fully exposes his position. For example, with T-Mobile, he gradually reduced his stake. He sold about half of the shares, but still retains a good chunk. This strategy prevents the market from sensing a panic exit and also allows it to take advantage of different price points to maximize profits. If you are an investor, this is a lesson in how to be impulsive or emotional selling. Everything at once may seem smart in the heat of the moment, but splitting the sale protects your investment and still leaves room for positive surprises. Want to win the market? Learn to manage your exits like Buffett, always with calm and control, never in a rush. Want to know when it's the right time to invest and when to hold on to your money? Click here to sign up and master this art with us. The mountain of idle cash. Buffett is preparing his next move. Did you know that the guy who was once synonymous with investing heavily is now sitting on a fortune in money that no one has seen before? Berkshire Hathaway now has more than $347 billion in cash. That's money sitting idle, waiting for the right moment to act. To put it in perspective, that's more than the combined cash flow of the biggest tech giants, like Microsoft, Google, and Amazon. Why hold so much money? Because Buffett knows that buying just because you have to is foolish. He's waiting for elephant opportunities, those giant ones that can completely change the game. But here comes the hotspot. With so much money sitting idle and few prey in the market, he may end up doing something he swore he would never do, paying dividends to shareholders. This could be a huge turnaround for Berkshire investors, who have historically only made money from stock appreciation, not dividends. If you want to invest wisely, keep an eye on this huge amount of money, because when it starts circulating, the market will feel it, and those who are prepared will profit greatly. Buffett selling giants? What's really going on with Apple and Bank of America? Pay attention. When Warren Buffett, the master investor, decides to sell a huge chunk of Apple and Bank of America stock, it's not a sign you should simply ignore. It's a powerful warning to anyone who wants to make real money in the market. Buffett has already transformed these two companies into veritable profit machines for Berkshire Hathaway. Apple, for example, isn't just a technology company. It's practically an economy within the stock market. And Bank of America, a financial giant at the heart of the US economy. So why would he be selling up to 66% of Apple and 40% of Bank of America? Because he's not a fan of blind bets. Buffett knows the market is expensive, very expensive, and he's playing with strategy, not emotion. He is taking part of his profits to reduce risks and diversify your portfolio. This is what separates an average investor from a true champion. Imagine yourself in a poker game. Even if you have good cards, sometimes it's time to collect some of your chips and wait for a better hand. Buffett is doing just that. And here's the part that a lot of people forget. Despite selling a good portion, he did not abandon these companies. There is still a lot of capital invested in them, as they believe in their long-term potential. But this movement shows that in such an inflated market, there's no point in being stubborn and betting everything on a single move, even if it's a sure bet. For those of you who want to invest wisely, the message is clear. Diversify, protect your gains, and be ready to act quickly when the market changes. Don't follow the herd. Follow Buffett, who knows when to hit the sell button and when to hold on tight. The market is inflated, and Buffett is fleeing before the explosion. Here's the truth. The US market is very, very expensive. Seriously, stock prices are almost twice as big than normal in relation to corporate profits. This is not just a feeling, it is a cold, cruel fact. For you to understand, there is an indicator called price earnings, PE, which shows how much you pay for a company's earnings. Historically, the market has hovered around 15 to 16 times earnings. Today we're at 28 times. A dangerous level. And if you think this is an exaggeration, there is the Shiller PE ratio, which averages profits over the past 10 years to provide a cleaner, more realistic view. And it's at 38, higher than before the big declines of 2000 and 2007. Not to mention the famous Buffett indicator, which compares the value of the stock market to the size of the economy. It is 57% above the historical average, a red flag. This means the following: the market is inflated, full of bubbles ready to burst. And Buffett, he's playing it safe, selling some of his stocks, piling up cash and waiting for the storm to pass. If you continue to invest in this overvalued market without care, you are setting yourself up to lose a lot when the bubble bursts. Be smart. Knowing when to exit is as important as knowing when to enter. Buffett is teaching this with his sales. Take advantage of this lesson before it's too late. The biggest pile of cash in history. Buffett is setting the stage for colossal opportunities. Imagine you're hoarding cash like a secret treasure. Now imagine that this treasure is the largest cash reserve ever seen in corporate history. More than $347 billion available, ready to be used at any time. To put this in perspective, giants like Microsoft, Google, Amazon, and Meta, which you know are true powerhouses, they don't even come close to that amount. Adding up the cash in hand at these companies, you still fall behind Buffett's pile. What led to this mountain of money? The answer is simple. Buffett has been selling shares in sequence, something unprecedented for him, accumulating this enormous capital reserve. This is not a sign of fear, but of strategy. Buffett is an opportunity hunter, and true opportunities, those that really move the market, don't appear every day. He has already called it elephant hunting. And if you recall, he said this back in 2013, when he had about $80 billion to spend. Now, with more than 4 times that amount, he's in a position of unparalleled strength, waiting for a unique opportunity to buy a giant company or make a deal that truly moves the needle for Berkshire Hathaway. But here's the thing, a lot of people don't realize, finding a private company worth hundreds of billions willing to sell isn't easy. It's almost like looking for a dinosaur in the 21st century. Such opportunities are rare, which is why Buffett is holding on to the cash, ready to act when the dino appears. Meanwhile, he's not just hoarding money for nothing. His stock portfolio is becoming more diversified, and his liquidity is so high that he can weather market storms with ease without being forced to sell in bad times. Now, think about it. If the market remains overvalued and the massive opportunities don't present themselves, what should Buffett do? The answer may be surprising. He could start paying dividends for its shareholders, something Berkshire Hathaway has never done, or almost never done, in its entire history. This possible change is a silent pump in the market, a sign that even the world's greatest investor recognizes that keeping all that money idle may not be the best strategy forever. For those of you who want to learn how to play the investment game intelligently, This story is a powerful reminder. It's not enough to just invest. You have to know when to hold, when to sell, and most importantly, when to be ready to attack. Buffett is showing that patience and preparation are far more powerful weapons than chasing every trendy stock. Those who understand this lesson will be light years ahead when the next big opportunity arrives. Buffett is selling even his biggest cards, Apple and Bank of America. Here's some news that has left many people speechless. Warren Buffett, the master of patience and loyalty to big companies, is selling large pieces of the two giants who made his fortune the most, Apple and Bank of America. Until recently, these two companies were the solid foundation of Buffett's portfolio, representing more than 60% of everything he had invested. Today, they only account for 35%. This is a drastic change, a clear message that the game is changing. And don't think he's abandoning these stocks because he's lost faith. Not at all. He still believes in the future of these companies. That's why he's holding on to some of the shares. But he's reducing his exposure because their prices are simply very high. This movement is what traders call make a profit. Sell when the price is high to secure a profit, without losing everything when the storm hits. Think about it. Buffett isn't someone who sells on impulse. He's known for buying to hold for years, decades even. So when he starts selling, it's because the outlook for him is getting better, the market is too expensive, and the risk of a downside is increasing. This movement highlights a warning that every investor should heed carefully. Even the biggest market bets can turn into trouble if you don't know when to exit. And here comes a powerful mental trigger for you. Don't fall in love with a stock. Loving an investment can blind you and cause you to lose money. Buffett, once called the buy and hold guru, is showing you that even he knows when it's time to sell. If you want to protect your money and grow your assets, you need to learn this lesson. The key isn't just to buy the best stocks. It's to know when realize profits and protect your cash flow for future opportunities. Buffett is speaking to you from the top, saying, the market is expensive, be smart and make your move. Here's the ugly truth that many investors ignore. Warren Buffett doesn't buy anything just because it's trendy or because everyone else is investing. He's a relentless bargain hunter, a true value hunter. He only buys when he thinks the price is fair, or rather cheap, and sells when he thinks it's too expensive. It's not about emotion. It's about math, strategy, and patience. Now, what's happening in the market? The stock price is quite inflated. To give you an idea, the average price of shares in the S&P 500 is almost double what it should be if we base it on the company's profits. This means many investors are paying too much, risking a major correction. And smart investors like Buffett are taking advantage of this moment to sell and accumulate cash. You know that old saying, buy low, sell high. Buffett is applying it masterfully now, contrary to what many do, buying high and selling low. But why isn't he buying more? Because, in his view, the price is so high that the risk of losing money in the future is far greater than the chance of making it. So he prefers keep the money idle for now, waiting for a better opportunity, a true hunter, waiting for the right moment to strike. And here's another warning for you. Don't get carried away by market hype. High prices are synonymous with danger, not opportunity. Buffett is giving you a signal. Hold on to your cash, be patient, and prepare for the next big deal. What he calls elephant hunting, that is, looking for giant, valuable investments at fair prices. Here's something that will blow your mind. Warren Buffett has more money in the account than invested in shares. They are unbelievable $347 billion in cash, ready to be used. And that is a historic record. To put it in perspective, giants like Microsoft, Google, Amazon, and Meta combined don't have that much cash on hand. And this full coffers is no coincidence. Buffett is accumulating this gigantic amount because can't find good opportunities to invest now. The market is very expensive, and he doesn't want to pay a high price that will put his assets at risk. But what's the plan? Buffett has said he's ready to hunt elephants, meaning he wants to buy big, worthwhile companies that could change the game for Berkshire Hathaway. Only now, with 3 times more money than before, the hunt has become even more difficult. Finding a company worth hundreds of billions that's for sale is nearly impossible. This scenario opens up a controversial possibility. Will Buffett do something he has always avoided, which is pay dividends to shareholders? Just imagine, Berkshire Hathaway, which has virtually never paid dividends, could start distributing some of that cash to investors instead of letting the money sit idle. This could be a sign that the market is so expensive that not even the world's greatest investor knows where to put his money. And for you, this is a valuable lesson. Even the best know when to hold on to their money and bide their time, or when to distribute profits to keep investors happy. Don't fall into the trap of investing without a strategy. Learn to view the market like Buffett, with patience, discipline, and a long-term vision, but knowing when to act quickly. Warren Buffett, the undisputed master of the market, is showing the way. There is no point in chasing quick profits in an inflated and risky market. He prefers to hold on to his money, wait for the right moment, and only then invest heavily, or even consider paying dividends, something almost unthinkable for him. This strategy isn't for everyone, but it's for those who want to build real wealth safely and with a vision for the future. If you want to invest like a champion, learn from Buffett. Patience, discipline, and a critical eye for the real value of things are your greatest weapons. While many are chasing the next fad, you could be laying the groundwork to win when the market corrects. Remember, idle money may seem idle, but for a savvy investor like Buffett, it's the fuel for the next big move.